You can't see my second laptop, can you? No. Nope. It's fine. Can you see my my IFB poking out, or is it okay? No, I've got no hair sticking out, do I? Hello, I'm Angeline Ong, and welcome to Beat the Street, the show that gives you all the tradable news and data you need to know ahead of the Wall Street Open. Coming up, rate cut expectations. Investors eye Fed rate cut comments amid signs of a cooling U.S. labor market. We've got a slew of Fed speakers this week and more numbers from the U.S. jobs market as well. And the earnings focus continues. We've had a relatively solid earnings season so far, and a still resilient U.S. economy is prompting hopes of a near-term soft landing. Amongst the big movers or big names to look out for this week, Uber, Lyft, and Disney. And also watching WeWork. The co-working giant's troubles are darkening the outlook for the world's biggest business hubs. Shares have been halted. We're waiting on an imminent announcement. Well, welcome to Beat the Street. Ahead of that Wall Street Open, this is how equity markets are looking. And let's give you a look at U.S. crude prices first, because they are falling ever so slightly. This is the daily chart here. And just taking a look at the Wall Street indices as well, just as we count down to the open, this is the U.S. Tech 100, which mirrors the NASDAQ, as you can see there. Quite a cautious open indicated. Also, let's check in on the US 500 as well. This mirrors the S&P 500. A similar picture there. No surprise, really, given we're waiting on a whole raft of data set to move markets. We've got lots of economic data to start off with. We've got consumer credit, weekly initial jobless claims, and also the University of Michigan Consumer Sentiment Report. Not forgetting, we have a slew of, as I mentioned earlier, Fed speakers on deck. Jerome Powell due to speak midweek. Markets will also hear from Fed governors Lisa Cook, as well as Christopher Waller and Philip Jefferson later in the week, with Dallas Fed President Lori Logan slated to speak Tuesday as well. Now, this is all key because after that chilly October jobs reading and the Fed holding its key rate unchanged for a second consecutive month, but hinting that near-term inflation risks were balanced. Many in the market are looking at any signs that the Fed could start holding off on any future rate hikes. Well, Liz Deakin, co-host of the Liz and Jenny Show from Tasty Live, part of IG, joins me now from Chicago. Liz, let's start off with earnings first. Which one's likely to prompt the most action?
Well, Angeline, it's great to see you. Thanks for having me. This week, I know there's a lot of earnings on deck, but I'm kind of looking at some of the EVs. So Tesla's up pre-market. They had earnings last week, and they actually took a little bit of a hit. So because of that, my eyes are going to be on Rivian this week and NIO a little bit later. So those are two rivals of the EV maker, and we'll see if they're going to take a little bit of the lead off the Tesla bump that's coming in this morning. So that's what I'm going to be looking at this week.
also, the other thing that investors are really keen on hearing is where the Fed goes next. Here, this side of the pond, we're all looking at any signs from Fed speakers this week to see whether they say or indicate whether or not rates will remain higher for longer. What are you hearing on the ground?
Angeline, as a former floor trader, I actually lead this in the people that are smarter than me, and I go to the CME Fed Watch tool, and it's pretty interesting because as of Friday afternoon, the markets we're saying 95% not increase versus 53% prior. So they're just saying that I think it's going to be not an increase, and you can go out a little bit farther too, but that was as of last Friday.
Thanks very much. I'm sure this will be a topical subject that we come back to you again and again before the next Fed meeting. Thanks so much, Liz. Now, speaking of Tesla, we've got Elon Musk announcing plans for a 25,000 euro car. That's right. This is according to Reuters sources, a 25,000 euro car. This would be incredible given that Elon Musk has been keeping the Tesla car prices higher than its rivals. But perhaps change in this plan is underway given that there is so much competition coming into the EV space from the likes of not just Rivian, but also like BYD, the Chinese rival. The plant near Berlin currently produces the Model Y, and it's set to expand, and staff have been granted a 4% pay rise. This coming as Elon Musk has also been, like it, love it or hate it, criticized for making the cars cheaper so that he keeps revenue and sales higher. But this could all be about to change, as even in the UK, we're seeing signs of more competitors coming into the EV market. Just showing you the Tesla shares here because they were indicated higher not too long ago. Let's take a look at the hourly chart because Tesla is, of course, all sessions on the IG platform. And just looking here right now, we're looking at a slightly lower open. However, earlier in the session, I can tell you that if you look at the daily here, we are looking at a higher start. 1.7% is the indication right now on the IG platform. As I mentioned earlier, they were up 3%, up higher previously in the last few hours. Now, as we spoke to Liz earlier, who spoke about the chilly jobs number and how US rates might progress in the coming months, Axel Rudolph from IG has also been taking a closer look at how the slew of economic data in the past week has changed the mood of the markets.
Yes, last week's softer economic data out of the US and also the subdued non-farm payrolls report changed rate hike expectations, with many market participants, as I just said, no longer expecting a rate hike to be seen in this cycle, and also rate cut expectations rising. If you go to December of 2024, these now priced in a 95 basis point rate cut, compared to 65 basis points of rate cuts being expected the week before. And all of that has led to great risk-on sentiment for the S&P 500, which last week has risen through the September to November downtrend line and not only closed above it, but also above the orange line here, the 55-day simple moving average at 4,354. So basically what's happening here is that we are approaching the mid-October high at 4,398, and a rise above there on the daily chart closing basis would mean that we've formed a bottom in the S&P 500 and that we could then head not just to the September high at 4,540, but most likely all the way to the July high at 4,607 before the year is out. So technically, we are in a very good position to, in the next few days, perhaps overcome the mid-October high, in which case a technical bottoming formation will have been formed, and that could then lead to the continuation of this year's, I should say, uptrend.
Thanks very much, Axel Rudolph there, giving us a sense of the technical side of things for the S&P 500, given the data and that chilly jobs report out recently. Now, NXP Semiconductors expected to report a fall in third quarter revenue, hurt by weak demand from sectors like communications. Let's have a look at the chart here for you. It's expected to say that demand was weak, this mirroring other semiconductor makers that had flagged this, if you remember, in the second half. What's also interesting is this comes at a time when the global chip sector did flag that perhaps things would pick up in the fourth quarter, but this has largely not materialized. And staying with earnings, Uber Technologies expected Tuesday to publish earnings of 7 cents a share. Now, this would compare to an 18 cents loss in the same quarter last year. Revenue expected to come in at $9.5 billion. Now, over the past few weeks, analysts have grown increasingly bullish on the stock, some of them upping their price target to $60 or higher. Uber shares have posted their best weekly performance since May last week, and Lyft's performance doesn't look as appealing either. Uber's competitor due to report midweek. Now, besides earnings, investors will be looking particularly at the group's active rider growth. To compete with Uber, Lyft had to lower its prices, potentially affecting the top line. Earnings are expected at 15 cents per share, roughly a 50% increase on the same quarter last year. Revenue is forecast at $1.1 billion. Now, Walt Disney, another one to watch midweek, just after the House of Mouse's 100th birthday. The company is expected to report earnings of 71 cents per share on revenues of $21.4 billion. Now, this compares with EPS of 30 cents and revenues of $20.1 billion the same quarter a year ago. It was at this time last year that Bob Chapek was dismissed after a poor set of earnings and replaced by Bob Iger, who initiated a $5.5 billion cost-cutting plan, cutting 7,000 jobs. Walt Disney made headlines last week when it announced it was willing to buy from Comcast the 33% of Hulu it doesn't already own. And in a statement published, Disney said it was ready to pay $8.6 billion for the stake, valuing Hulu at $27.5 billion. Negotiations will undoubtedly be harsh between the two groups. Comcast's CEO recently said it thinks Hulu is worth more than double Disney's valuation. Now, the announcement was positively welcomed by the market, lifting the stock away from the multi-year low set last month. Now, we're also watching out for WeWork for you. Its shares halted, and let me just check now to see what is happening, whether anything has broken. And I can confirm that its shares are still halted pre-market imminent news. Now, this company, which was once privately valued at $47 billion, and now, well, what a fall from grace, has a market cap of just around 121 million. Prior to today, the company, which went public in 2021, was slapped with quite a few downgrades too. S&P downgrading WeWork to SD on a forbearance agreement, and Fitch downgrading WeWork to RD. WeWork, as I mentioned earlier, went public in 2021 and was a darling during lockdown and also when lockdown was over. However, and pre-lockdown, I might add, but skepticism over its business model as more companies had a strategic hybrid model in place meant that WeWork taking long-term leases and renting them for short-term was no longer feasible. Its shares tanked nearly 50% to a record low sometime last week after media reports that the flexible workspace provider was planning to file for bankruptcy. And just before we go, a quick look at oil, if I may, because crude is currently falling, as you can see there, after some relevant news overnight and also in the market. We had Saudi and I believe also Russia reaffirming their commitment to extra voluntary oil supply cuts until the end of the year. Last Friday, the U.S. weekly oil rig count fell by a net margin of 7 to 618. U.S. oil rigs fell by 8 to 496 this week, while gas rigs rose by 1. And before we go, let's have a last look at how the market is looking. Just looking at the 200 for you, which is here, the US 500 rather, which mirrors the S&P 500. Cautious open there indicated. Let's take a look at the US Tech 100 as well, which mirrors the Nasdaq for you. This has also been a very interesting space given its resilience despite the ructions of the market and previous concerns about higher interest rates, which will of course be bad for markets. But as you can see there, even on an hourly chart, it has come back now since the end of October. And that's all for this edition of Beat the Street, the show that follows a trading action helping you position yourself ahead of the opening bell. For more trading insight, do follow me on at IGCom and at Angeline Ong on Twitter. This is IGTV.